Hi, everyone. Welcome to the Week in Charts, where we talk about the most interesting charts and themes in markets and investing. So, a lot to talk about this week. Let's dig in. First topic I want to talk about is the most universal tax of all, that being inflation. Great economist Thomas Sowell once said about inflation, it's a way to take people's wealth from them without having to openly raise taxes. And so, we're really seeing that concept play out month after month. We have a chart here of CPI. Latest reading, 7.5%. It's the highest we've seen since 1982. And if we take out food and energy, which is known as the core CPI, that's in the dark blue, that rose to 6%, also highest since 1982. So any way you look at it, inflation's at a 40-year high. And where's this coming from? What's driving that price increase? Well, the troubling thing is it's really been broad-based. It's not just one sector or area of the economy. We're seeing it pretty much the dynamics of higher inflation across the board. So if we look at energy prices, fuel oil, gasoline, over 40% increases there. Car prices, both new cars and used cars. If you look at spending in terms of food, away from home and at home, increasing, everything is up above the average from pre-COVID. And so we have a number of different factors driving that. We've talked about that, but just briefly, money supply increasing 40% in 2 years. We have the debt going up by 7 trillion. So we borrowed a lot of money. It's in the economy now. The money supply has increased, and that's going to lead with a lag to inflation. So we're seeing the effects of that now. Now, how accurate is that 7.5% number? I've questioned it, and I think there's good reason to believe that it's actually higher than that number. Why I think that is that shelter component. If you see that all the way at the bottom of this chart, 4.4% increase in shelter. Well, this is likely understating the true number. So shelter is by far the biggest component of CPI. It's at 33% of the index. So most people, their biggest monthly spending category is housing. In terms of either rent or mortgage payments. And for a lot of people, that number has gone up more than 4%. So if we look at rents in the US, there's an index that came out that said there's been an 18% increase in rents. That's the highest we've ever seen for a 1-year period. And we know what's going on with home prices. We've seen a 19% increase in the US. So is that 4% number accurate for shelter? Likely not. And therefore, that overall number is likely higher than 7.5%. Now, in terms of policy, if we look at the right chart here, we have global central bank rates, and U.S. policy is really at odds with that. So, with the rest of the world, and becoming more, more glaringly an outlier each and every month. So we have a real central bank rate in the U.S. at negative 7.4%, and other than places like Turkey and Argentina, that's the lowest real central bank rate we're seeing in the world. So a number of countries have already started to normalize policy. They've been doing so month after month. If we look at places like Mexico and Russia, they've hiked a number of times, Brazil as well. And even in the developed world, the UK has hiked now. So we're seeing just a more of an urge to start normalizing. And in terms of global inflation rates, the U.S. really stands out in the developed world now. It has actually a higher inflation rate than India and Mexico. So something really we haven't seen in quite some time. And so this kind of divergence is going to have to rectify itself one way or another. And the expectation is that it's going to start to converge, where U.S. policy starts to look like the rest of the world. So we're going to see a normalization. The question, of course, is how much, and we'll talk about that in a bit. But next, I want to talk about is this interesting reading that we got from the consumer sentiment number from University of Michigan. So it really plummeted 61.7. That's the lowest we've seen outside of a recession ever in terms of this index. So if we go back in history, it's the lowest we've seen over a decade. 2011 bear market was the only other time it was this low where there wasn't a recession. So during that bear market, you had a very brief but swift downturn in stocks. They fell a little bit over 20%, and you had some consumer sentiment sour very quickly. That wasn't long after the financial crisis, and people thought there was going to be a double dip recession at the time. They ended up being wrong. But other than that, if you look at the other readings this low, you have recession. So you have the 73-75 recession, 1980 recession, and 08-09 recession. So is this pointing to another recession here and now? I don't think so. I don't think we're in a recession today. If you look at a broad base of indicators, it still looks like real output is increasing. But if this were to persist, I think it becomes a problem, right? Consumer spending is very important to the U.S. It's the biggest part of our economy. And if consumers are becoming more increasingly concerned about things and they pull back, well, that, of course, will lead to a recession. And what are they most concerned about today? It's probably no surprise. It would be that inflation number. So in that survey, they asked people, what are you most concerned about? And nearly half of them said that they don't believe that their wages are going to keep pace with inflation over the next year, so that their real earnings are going to go down. And that would really be a continuation of a trend that we've seen over the last 10 months. So here's a chart showing the increase in average hourly earnings in the US versus inflation. And you don't want to be in the bottom part of that chart, because that means your purchasing power is going down. And so for the last 10 months, we've seen that be the case, where wages are not keeping pace with inflation, and consumers are rightfully concerned about that, because if that continues, that's a decline in prosperity. People start to feel poorer, and it's really the big driver in terms of sentiment. You don't want to have that situation persist for too long. Now, the question, of course, isn't higher inflation here to stay? And so we had that 7.5% reading, but what will inflation be a year from now? Is it going to come back to normal? Is it pre-COVID? Again, it averaged 22% per year for 20 years. So are we going to come back to that? Is it going to stay elevated? I put that poll out on Twitter this past week with some interesting responses. So I think very few people are really left in that transitory camp where they're thinking that inflation is going to come right back down to pre-COVID levels. So only 6% of people said a year from now we're going to have less than 2% inflation. Most people, over 60%, say 4% or higher. And that's really in alignment with a number of other surveys that we've seen. So out of the New York Fed, they do every month a survey of consumers asking, where do you think inflation will be 1 year from now and 3 years from now on average? And the last reading we have is 6% over the next year, and then averaging 4% per year for the next 3 years. So that's well above, of course, the average, the pre-COVID average. So people are expecting inflation to remain elevated. Now, why is that important? Because expectations are big drivers of future prices. So if people are thinking that prices are going to go up, they tend to be more tolerant of that when they go out and purchase something. So if they're become conditioned that prices are going to be up 4 or 5%, then they're not going to fight that in terms of spending until they have to. So it's kind of a self-fulfilling prophecy in a way, that you don't want those expectations to get out of control, because that in turn will drive future prices, which in turn will drive higher expectations, and so on and so forth. So this is something you want to see come down. I think consumers will need to see evidence that inflation rate is starting to slow before they change their expectations, but something clearly to watch. That's something that the consumer in the US is now worried about, which was a big shift from a year ago. A year ago, the thought was we would just borrow whatever we want, spend it today, we'll worry about it later. Well, now is later, and people are starting to rightfully be concerned about that, because their wages are not keeping pace with that increase in prices. So on that topic, we have to talk about the Fed. Has the Fed lost all their credibility as an inflation fighter? So this is a big shift in terms of the Fed from where we were in let's say, early 1980s. So you had Paul Volcker take over as Fed chairman in 1979. Inflation was very high at the time, and he immediately took aggressive actions. On a Saturday, which became known as a Saturday night special, he actually hiked rates 100 basis points. He went on to keep hiking rates until they hit 20% in terms of the Fed funds rate. So we're at zero today. He hiked rates all the way to 20%. And in doing so, he risked a recession, which there were two of them, bear markets and stocks, which we had a nasty one in the early 1980s. But he did that knowing the risks of those things, saying that curbing inflation was more important. So I think the question today is the Fed willing to do what they have to do to get inflation under control? And should they move? I think it's pretty clear at this point that they should have moved a long time ago. If we look at the real Fed funds rate, it's the lowest in history with the exception of 1974. So having a negative 7% real Fed funds rate at this point in time just doesn't seem to make sense at all. If we look at prior periods where the unemployment rate was 4% in the US, you had a much different picture in terms of the real Fed funds rate. So only one other time did you have a negative real rate. That was back in 2018. So much different policy, really no justification for 0% rates. And the expectation is that this is going to change. So the Fed has two mandates. They have to balance these mandates. One is maintaining price stability, and the other is trying to maximize employment. We have unemployment well below the historical average. So they have to start thinking more about that price stability. And the argument that I've made and a number of other people have made is they should have started earlier. They didn't obviously agree with that. But here we are. They're now behind the curve and they're going to move. The question is how much and how fast, right? So in terms of expectation, it was a pretty big shift after the CPI report last week, where market participants are now thinking the Fed's going to be more aggressive. So in the top chart here, we have 1 year through 10-year Treasury yields. They all rose to their highest level since the start of the pandemic. The 10-year is now back above 2% for the first time since 2019. And we have pretty much all durations moving higher on the expectation that we're going to see that normalization in the coming months. So getting to Fed funds futures, what are the expectations? What's the big shift? Well, now more than half of people are thinking we're going to get a 50 basis point hike in March. And these are market implied odds. And they think there's going to be another hike in May and then again in June and then in July. So is the Fed going to be this hawkish, this aggressive? I think a lot of people are doubtful that they will be, because you're going from a period of extreme easy monetary policy then to a relatively hawkish stance. So it seems unlikely to me that they'll make that transition that quick, but clearly the Fed has to do something if they want to maintain any credibility. So now is the time to act. They have to move, and they have to be willing to take some pain, right? The markets are already reacting. We've seen in the past month or so with this correction in stocks and big correction in high growth stocks. Fed has to be willing to accept that as a consequence, right? You can't normalize policy and expect there to be no reaction. So they'll have to balance those risks. But I think that the rate hike is coming. For people who think that the Fed won't hike rates because we've had this correction in markets, I think they're wrong. We've seen it from the language in the Fed. They're becoming more concerned. They're stop using the word transitory, and they don't want to be on the wrong side of history, which they already might be at in terms of not responding to a clear and present threat, right? We know the inflation rate today. We know it's going to persist at least for a few more months, if not longer. And the Fed just can't stand there and accept that to happen, or they're not following their mandate. And so I think they're going to want to start to move. The question really is how aggressive, and that's going to depend on a lot of factors that we don't know today. So what's going to be the path of inflation this year? What's going to be the path of employment? What's going to be the path of markets? So if there's a severe downturn in markets and not just a correction like we've seen, the Fed is probably not going to be as aggressive. If unemployment starts to move back up, they'll likely won't be as aggressive. But here and now, as it stands today, I think the balance is that they're going to start normalize, because the risks of higher inflation far outweigh the rewards that we're getting from keeping rates at 0%. In terms of next topic, valuation. So this is a question that I get a lot, and especially in recent weeks, because we've seen just this crash in high growth stocks. We've seen this multiple contraction in the highest growth segments of the market. So this is a chart of the ARK Innovation ETF, which really has been the representative really of this higher growth segment of the market. And we've seen it fall over 50%, and many stocks within this high growth category falling even more. So we've seen a revaluation in this one segment of the market, but I wanted to take a more broader look at, let's say, the NASDAQ 100, which is really one of the most popular areas for investors. It's been up 13 years in a row entering this year. And what has the recent pullback in that market done to valuation? So I put together a chart showing the median price to sales ratio of the NASDAQ 100 going back the last 10 years. And what we see is a pretty substantial increase. We start at 3 times sales back in 2012. We went all the way up to 8.5 times sales last year, and now we're down to around 6 times sales. So if we're being objective here, we're looking at this chart. It would be hard to argue and say that stocks are cheap after this pullback. They're certainly cheaper than they were last year, but saying they're outright cheap doesn't seem to make much sense. But I think the argument a lot of people make in terms of valuations, they try to justify it saying, well, interest rates are still really low. You only have a 10%, a 2% 10-year yield, and you have a 0% Fed funds rates. And so therefore, valuations should be higher today than they were 10 years ago, let's say. The problem with that argument is it really doesn't hold up on a number of levels. First of all, if you go back and look the last 100 years, there's very little correlation between valuations and interest rates. So at times they appear to be related, but if you look at the broader history, they don't. So I'll put a link to a post on that I wrote last year, kind of disproving that misconception. But if we're just looking at the last 10 years, we can really disprove that as well, because 10 years ago in 2012, when the median price to sales ratio was at 3 times, interest rates were exactly the same as they are today. So the 10-year yield was at 2%, Fed funds rate was at 0%, and we had a multiple of less than half of today. So if we're asking the question and being honest, can valuations go lower? Certainly, they're certainly not cheap even after this correction. If we look at longer history, and interest rates being low is not enough to say that they deserve this higher multiple. So it doesn't mean that the multiple will come down. You could get it to come down in 2 different ways, right? You can have sales increase and just stocks go sideways over time, or you could have stocks continue to fall and correct, and that would get you to that lower valuation quicker. So we'll see what happens, but being objective here, can the multiple go lower? Yeah, I think the answer has to be yes. Trade deficit. So just quickly, we got the final trade number for last year, and what we saw was really the widest trade deficit for the U.S. in history, $859 billion. And what's driving this? Well, you had those 2 huge stimulus bills, one at the end of 2020, one in early 2021. That drove that huge spike in consumer spending, and the U.S. Likes to buy a lot of goods from overseas, and so we had more imports than we've had ever before, and that's really driving that trade imbalance. And I think the question is going to be for policymakers, for companies, now that we've gone through the pandemic and the problems with shortages, do we need to build more of a manufacturing base in the U.S. To be less reliant, on overseas, and maybe alleviate some of the problems we've had in terms of ports and supply chains and so on and so forth. But just a stunning number in terms of the trade deficit for last year. And the last topic I want to talk about is COVID. More good news. So we got case numbers here in the U.S. now falling over 80% from their peak just a few weeks ago in January. Just a stunning collapse. So we have this parabolic move higher during, the upswing where people are gathering at the end of December for holidays. And so you have the peak in terms of infections show up a few weeks after that. And then just as we've seen many times with these waves, it comes right back down. So great news on that front. Well, how is that impacting, the economy and different things? Well, we talked about it last week, but I'll touch on that again. I think that this is going to lead to a second great reopening. I think a lot of people are feeling more comfortable traveling. I think we're going to see those numbers really play out in the next few months as we head into the spring. So you're going to see that transition again, where people are going to travel more. Leisure sector, consumers still have a lot of cash on their balance sheet, and they're going to want to get out and spend it. So in another interesting thing we saw in the last week is in terms of policy for a number of states. So 11 different states, many of which have been the most restrictive in terms of mandates, loosened some of their mask mandate policies. So this is a big shift. And I think the thinking here is a few things, but most important, is that the tide is turning in terms of the public perception. So whereas a year ago, people were much more supportive in terms of restrictions and they were more compliant. Today, people are feeling very differently. They want an end to it. If you watch the Super Bowl, you probably saw the entertainers and celebrities and politicians walking around without masks. And many people are asking, well, why do we still have to wear them? And so you can't have that hypocrisy go on for very long before people start to get angry. And politicians, more than anything else, want to be reelected. So if they sense that their constituents are going to be becoming angry about this stuff, they're going to start to move. So we saw 11 states start to relax those mask mandates. Unfortunately, New York and California continue to have their school mask mandates. But I think that too, the tide is turning. People are recognizing, they're watching the Super Bowl and recognizing the ridiculousness of having children in masks all day while people are adults who are at higher risk, not wearing masks in restaurants, bars. And so this is a chart showing the infection fatality rates by age group. And this is really just a stunning age gradient in terms of the risk of death. So if we look at children 0 to 17 years, you have a substantially lower risk than an 80-year-old has over 1,000 times higher risk of death. So does it make sense to have a more stringent policy in terms of restrictions for children than you do for adults, and particularly older adults? Of course not. It doesn't make any sense. So I think you're seeing, I put a poll out on Twitter asking if you think that masks should be optional or mandatory. And over 60% said they should be optional at this point. So I think in the coming weeks and months, you're going to see that change as well, which I think is a good thing. We need to try to get back to normal. Where we are in terms of COVID is very different than we were a year ago. If we look at a number of different factors, we have the vaccines today, which have significantly reduced the risk of hospitalization and death. So if we look at fatality rates today during the Omicron wave, much lower than they were a year ago. We also know more about natural immunity, which appears to be very strong and durable in terms of protecting against severe disease. And my current estimate is that over 80% of Americans at this point have gotten COVID. So we have that extra level of protection. So for all of these reasons, all of these factors, I think people are starting to move on. And we're going to start to learn to live with COVID and give people the freedom to live their lives and assess their own risk. So that's what freedoms are about. And if you're going to have restrictions, let them be at the more local level and not a statewide mandate. So let localities determine what's best for themselves at this point in the pandemic. But so I think this is a great trend. Hopefully we see it continue. And it's something to really be positive for, because we want to get back to normal and we need it at this point. So that's it for this week. Have a great week, everyone. We'll see you next week. Thanks for joining us.